Hi everyone, welcome to Anna's Analysis. In the last video, we shared Meta's development, business structure, profit model, and future investment plans. We all know that the core of value investing lies in finding companies with strong competitive advantages, robust cash flow, and reasonable valuations. For a giant like Meta, which has transformed from social media into AI and the metaverse, today, we'll conduct a comprehensive analysis from 3 dimensions: competitive advantages, financial data, and valuation. Meta's moat. I believe Meta's core competitive advantage has 2 main layers: its social network and its AI infrastructure and large-scale models. Let's take a look at social networks first. As of 2026, Facebook, Instagram, and WhatsApp constituted the world's largest social media matrix. The core of the network effect is the more users a platform has, the higher its value. When all your social relationships, such as family, friends, colleagues, and clients, are on these platforms, the switching costs become extremely high. The app family almost monopolizes the attention span of users worldwide, forming the foundation of Meta's advertising business and providing it with unparalleled data assets. The user's social relationships on Facebook, aesthetic preferences on Instagram, and immediate needs on WhatsApp are integrated in the background to form a comprehensive user profile, making ad targeting exceptionally precise. Meta's app family is no longer just a few independent apps, but a single advertising backend plus multiple distribution outlets. Next, let's take a look at AI infrastructure and large models. Between 2023 and 2025, Meta successfully reshaped itself into an AI giant. Through its open-source Llama series of large models, Llama is becoming the underlying operating system for large model development. In August 2024, the official Llama download count reached 350 million, and this number is projected to grow exponentially by 2026. Most enterprise-level AI applications typically choose Llama as their first choice when selecting models for fine-tuning. This means that millions of AI engineers worldwide are developing based on Meta's logic, tokenizer, and architecture. Meta's use of Llama has forced the entire industry to follow its lead, much like Android's influence on phone hardware specifications. Almost all AI inference acceleration chips on the market prioritize performance running Llama as a core KPI when they are released. By open-sourcing Llama, Meta achieved 2 strategic goals. One advantage is that without Llama, developers might have had to rely on APIs from OpenAI or Google. Meta neutralized its competitors' pricing power by opening up the platform. Secondly, countless developers are optimizing Llama, and these optimizations from the world's top minds feed back into Meta. This crowdsourced development allows Meta to maintain Llama's world-class performance at a lower cost. Countless developers have built applications based on Llama, which gives Meta a huge voice in setting AI industry standards. Furthermore, Meta's investment in AI infrastructure has become the cornerstone of the company's survival and competitive advantage. Meta's investment logic is completely different from that of cloud vendors, who make money by selling computing power. Its goal is to achieve the full AIification of its social ecosystem. The core objective is to improve the return on investment of advertising. By investing heavily in computing power, Meta has achieved full automation of ad distribution. By the end of 2026, Meta expects to achieve full automation of ad creation, which relies on a massive back-end GPU cluster for real-time inference and creative generation. In addition, the AI infrastructure will support AI smart glasses and future AI agent services. Zuckerberg has explicitly stated that AI agents will become Meta's next multi-billion-dollar business growth driver. When Meta has more than 1 million GPUs, even powerful competitors find it difficult to match its computing power scale. As value investors, while recognizing the competitive advantage, we must also be wary of the following threats. One factor is the emergence of competitors within the same app family across multiple sectors. These include TikTok and YouTube Shorts in the short video field, WeChat, Telegram and Discord in the instant messaging field, and X in the real-time social networking field. The second is the black hole of the reality lab. Although the metaverse division has built up technological reserves in the VR/AR field, it is still in a state of huge losses, which is a continuous drain on free cash flow. Next, let's take a look at Meta's financial data. Meta can be viewed as an advertising company combined with an AI infrastructure company. Therefore, our financial analysis can focus on the following 5 aspects. 1. Revenue growth and gross margin. Looking at revenue data from the past 5 years, revenue experienced negative growth in fiscal year 2022, but returned to a growth trajectory of over 20% in 2024 and 2025. What does a 20% growth rate mean? For a company with annual revenue exceeding $200 billion, maintaining 20% growth means a net increase of approximately $40 billion annually. This increase is equivalent to the total revenue of a mid-tier S&P 500 company. Mature giants, such as Apple and Google, typically have a compound annual growth rate between 10% and 15%. Meta's ability to achieve over 20% is a very rapid growth rate. We also need to understand the reasons behind the negative revenue growth in 2022, because only by clearly understanding the reasons for the decline can we predict whether similar problems will occur again. Fiscal year 2022 marked the first annual revenue decline in Meta's history. There were 3 main reasons. The first issue was Apple's Apps Do Not Track policy, introduced in 2021, which cut off Meta's access to precise user behavior data. This directly weakened the efficiency of ad delivery, leading to a significant drop in ad prices. Meta estimated at the time that this policy costed approximately $10 billion annually. The second reason is that in 2022, the world faced high inflation and the Federal Reserve's aggressive interest rate hikes, leading business owners to generally reduce their advertising budgets. The third reason is that TikTok was in a period of traffic harvesting at the time, and it was taking away a lot of user time from Facebook and Instagram. These 3 points actually offer several important reminders for value investors. First, we cannot look at financial data alone. Short-term revenue and profit are often just results. What is more important is the underlying business structure and long-term trends. Second, competitive advantages are not static. Even the strongest companies can be weakened by technological changes or platform rules. Truly excellent companies continuously invest in research and development, constantly strengthening and expanding their competitive advantages, rather than being held hostage by competitors. Third, if a company's revenue structure is too singular, its ability to withstand risks during an economic downturn will be significantly insufficient. Once its core business is impacted, it is prone to a systemic decline. Having discussed revenue, let's look at gross margin. Gross margin is a core indicator for measuring the width of a Meta moat and the quality of a business model. Meta's gross margin has consistently remained at a high level, meaning that after deducting direct costs, Meta retains approximately $80 on every $100 of revenue. This level far exceeds that of manufacturing or typical retail, demonstrating advertisers' extreme reliance on its platform ecosystem. It is precisely because of its high gross profit margin that the company can invest heavily in development, AI, and the metaverse. The cost items that determine gross margin primarily include data center depreciation and energy expenditures. If Meta's gross margin declines for several consecutive quarters, this is usually a warning sign, meaning either pressure from competitors is forcing advertising price reductions, or Meta must invest disproportionately in computing power to maintain current advertising effectiveness. 2. Profitability. To assess the profitability of Meta, we focus on 3 key metrics: operating profit margin, net profit, and net profit margin. This financial data records the entire cycle of Meta, from its darkest hour to its full recovery, and then to its strategic investment period. In fiscal year 2022, net income shrank dramatically to $23.2 billion, with profit margins plummeting from 33% to 19.9%. This was the year that Meta's competitive advantage faced its most severe challenge. When core advertising efficiency was hampered, Meta's high fixed costs generated a huge negative leverage effect. In fiscal year 2024, the profit margin surged to a peak of 37.91%, and the operating profit margin also recovered to a high of 42%. This demonstrates Meta's extremely strong self-recovery ability. Through significant layoffs and reductions in non-core expenses, Meta proved that its business is extremely profitable. Profits can quickly rebound with just a little cost control. The operating profit margin for fiscal year 2025 remained at an extremely high level, with only slight fluctuations compared to 2024, indicating that the profitability of the core business has not shrunk. If you only look at the net profit margin of 30.08%, you might think Meta is on a downward trend. The decline in net profit margin is mainly due to a significant increase in the provision for income taxes in 2025, which is an accounting noise. If we exclude non-operating factors such as taxes, Meta's current operating efficiency remains at a historically high level. The next thing we need to focus on is whether this operating profit margin of over 40% can be maintained under the massive AI capital expenditures expected in 2026. If the operating profit margin starts to slip towards 30%, it means that the investment in AI has not yet brought commensurate advertising revenue.
Cash flow and shareholder returns. To assess the health of cash flow and shareholder returns, we can focus on 4 key areas: operating cash flow, free cash flow, share buybacks, and share dividends. In 2025, Meta's operating cash flow reached $115.8 billion, maintaining a high growth rate of over 25% for 3 consecutive years. This indicates that Meta's core business has significantly improved its monetization efficiency after experiencing a downturn in 2022. This is the foundation for Meta's confidence to invest heavily in the AI field. EPS remained largely flat in 2025, but free cash flow decreased from $54 billion to $46.1 billion. Value investors typically consider free cash flow to be a more reliable indicator than EPS. The divergence between these two in 2025 suggests that Meta's profits were not entirely realized, but rather converted into expensive server and hardware assets. Meta invests approximately $44 billion annually in share buybacks and will pay approximately $5 billion in dividends annually starting in 2024. Even during periods of significant capital expenditure, Meta's commitment to rewarding shareholders demonstrates its financial confidence. Currently, the $46.1 billion free cash flow is more than enough to cover the $5.3 billion dividend. However, if the free cash flow continues to decline in the future due to the computing power race, resulting in insufficient coverage, Meta may be forced to choose between continuing to invest in AI and maintaining dividends. If Meta significantly increases its dividend per share in the future, it may indicate that the company has not found better investment opportunities. For tech stocks, this is sometimes interpreted as a lack of innovation. We can observe the ratio of Meta's dividend payments to its net profit. As long as this ratio remains at a low level, like 10% to 20%, it is healthy. 4. Research and development expenditure and capital expenditure. Capital expenditures are projected to double to $69.69 billion by 2025. This looks alarming, indicating that Meta is purchasing chips and building data centers at an unprecedented pace. This is also the direct cause of the negative growth in free cash flow in 2025. In 2025, capital expenditures accounted for 60% of operating cash flow. If capital expenditures continue to remain at $70 billion or even higher in the coming years, but operating cash flow growth slows, then Meta's free cash flow will shrink further. We need to consider, will this money being poured in truly translate into increased revenue? The surge in R&D spending in 2025 brought R&D to approximately 28.5% of total revenue. This is an extremely high percentage. For established large-cap tech stocks, such as Apple or Alphabet, R&D spending typically accounts for around 10 to 15%. This indicates that Meta is still in an extremely aggressive, heavy investment phase and has not yet entered a stable period of profit harvesting. So where does Meta's R&D investment primarily go? I looked it up, and it mainly covers 3 areas. The largest portion is AI infrastructure, primarily used for the development of the Llama series of large models and the corresponding software optimization and generative AI feature development. Another portion is used for the metaverse business, which is still burning money. The remaining portion is used to fix and upgrade the advertising recommendation system. Increased R&D expenses foreshadow rising depreciation and amortization costs in the coming years. If AI monetization falls short of expectations, these depreciation costs will act as a heavy burden, dragging down future gross margins and operating profit margins accordingly. Next, we need to observe whether the high R&D investment translates into revenue growth. If the revenue growth rate outpaces the R&D growth rate and the operating profit margin does not decline significantly, then the investment is healthy.
5. Core operational data. Financial data is the result. User data is the cause. If user time is eroded by other platforms, even if the financial statements look good now, the future value will shrink. From Meta's user data, we can see daily active users, DAU, and average revenue per user, ARPU. Before looking at the data, let's briefly introduce these 2 technical terms. Daily active users refers to unique users who have logged in or used at least one product in the Meta family within the past 24 hours. Deduplicated means that if you browsed Instagram in the morning and replied to a WhatsApp message in the afternoon, you will only be counted as one user in DAP statistics. Average revenue per user is the average amount of money each active user generates over a specific period. The calculation is straightforward. It's total revenue divided by the total number of users, which represents the number of active users during that period. A higher ARPU indicates a stronger monetization capability per user. Now let's take a look at the data for these 2 items. By 2025, Meta's family of apps will reach 3.58 billion people daily, approximately 44% of the global population, and an even larger percentage of all connected internet users worldwide, highlighting the unparalleled reach of the Meta platform ecosystem. Despite its massive platform size, Meta's daily active user growth rate has remained consistently above 5%. In 2025, the growth rate accelerated again to 6.9%, adding approximately 230 million net DAUs within a year. This demonstrates that Meta's investments in AI-driven content recommendation, short video interaction, and emerging market penetration are delivering measurable improvements in user engagement and retention at the platform level. In 2025, Meta's average revenue per user was $57.03, a 15% increase from 2024. An increase in ARPU can be attributed to either more ads shown to users or a higher cost per ad. If the increase in ARPU is due to more ads, it may harm the user experience and lead to user churn. Healthy growth should be achieved through more precise AI-driven ad targeting to improve conversion rates, thereby increasing the cost per ad. Advertising revenue is a barometer of the economy. During an economic downturn, businesses are among the first to cut advertising spending, which directly impacts ARPU. Summarizing these 5 financial metrics, we can conclude that Meta's core business is extremely stable, and its application family is highly efficient at monetization. Its asset allocation is shifting from social software to AI infrastructure, which increases financial leverage and widens its competitive advantage. As value investors, we also care about whether the valuation is reasonable. Now we move on to the 3rd part of our video, Meta valuation analysis. Commonly used valuation methods by investors include relative valuation methods, such as PE and PEG, and absolute valuation methods, such as DCF. We've covered these in previous videos introducing financial data, including their calculation methods and limitations. Interested viewers can refer to those videos. Today, I want to use the PE ratio valuation method to assess the reasonable purchase price of Meta. Simply put, stock price equals PE times earnings per share. The first step is to determine the EPS. First, we need to understand that the stock market reflects expectations. By the end of 2026, the market is no longer concerned with how much the company will earn in 2026. Everyone is trading on 2027, buying into how much the company will earn in the future. Therefore, when estimating the stock price at the end of 2026, it's more reasonable to use the EPS estimated for 2027. Let's look at the EPS forecast given by Yahoo Finance analysts. The EPS for 2027 is projected to be 34.38. The second step is to predict the PE ratio at the end of the year. The current forward PE ratio is 22.62, which is the multiple the market is willing to pay for earnings over the next 12 months in April 2026. Assuming that market risk appetite and Meta's growth story do not change drastically by the end of 2026, the market will likely still be willing to pay a similar multiple for the EPS of the next 12 months, i.e., the full year of 2027. Looking at the EPS forecasts from Yahoo Finance analysts, 2026 is projected at 29.59, representing a growth of approximately 26%, and 2027 at 34.38, representing a growth of approximately 16.2%, indicating a slight slowdown in growth rate. Based on Meta's historical data over the past 5 years, the PEG ratio is approximately 1.3. Therefore, we can estimate a reasonable PE ratio at the end of the year to be 20.8. Based on the EPS and PE forecasts from the previous two steps, we can arrive at a target price of $715.1 by the end of 2026. The current price is $663, representing an upside potential of 7.8%. It's important to note that Yahoo Finance's 2027 EPS growth forecast of 16.2% is based on the average of 51 analysts, and this forecast is subject to change. If you believe that Meta's higher capital expenditures in 2026 can translate into growth exceeding 16% in the future, then there is significant upside potential for its price. Based on the target price, subtract your desired return to find the appropriate purchase price. That's all for today's video. If you found it helpful, please remember to like and subscribe. In the next video, I'd like to talk about Google. Google is one of the world's most influential technology companies, starting with a search engine and now developing into a super platform spanning the internet, artificial intelligence, cloud computing, and hardware. If you're interested, please stay tuned. See you next time.